Hi, I'm Ben Cohen, an Employee Benefits Relationship Advisor at Rose Street Advisors. Today we're going to be talking about health savings accounts, or HSAs. Let's learn more.
What is an HSA? A health savings account, or HSA, is a pre-tax account that you use to pay for eligible medical, dental, and vision expenses now and in the future. Some of the rules that apply are the fact that you must be enrolled in a high-deductible health plan to contribute to this account. You do own this account. It stays with you forever and ever and ever between jobs and into retirement. And just like any other asset, you name a beneficiary for it in the event of your death. The employee premiums on a high-deductible health savings account plan are typically lower than traditional plans, and you can use some or all of those premium savings to fund your HSA account. The funding of the account can be done with your contributions as well as any contributions from your employer, and they're typically done through payroll. One of the main advantages of a health savings account is that it is triple tax advantaged, meaning money goes in tax-free, earns interest tax-free, and comes out tax-free for eligible expenses. As I said, you have to be enrolled in a qualified high-deductible health plan in order to contribute to your health savings account. So what is a qualified high-deductible health plan? Well, part of it is from the IRS, and that means that you have to have a certain deductible level, $1,600 for an individual or $3,200 for two-person or family in 2024, or going up in 2025 and then annually after that. The other item is that all expenses must go towards meeting your deductible. That means there's no first dollar coverage, no co-pays for things like office visits or for prescription drugs. You pay the full discounted cost of those goods or services towards your deductible. The IRS dictates each year how much you can contribute to your health savings account. If you're single in 2024, that amount is $4,150, going up in 2025 and annually each year after that. And for a family, it's $8,300 in 2024 and going up each year after that. In addition, if you're 55 or older, you can contribute an additional $1,000 into your account to help you save additional money for retirement. So how does the high deductible and health savings account plan work? Typically, you contribute money to your HSA either in a lump sum payment or through equal payroll deductions. Just like your checking account, funds are only available to use once they're in your bank account. And then you can use your HSA dollars to pay for health insurance deductible expenses, along with other qualified expenses such as medical expenses, dental, and vision expenses. The best part is what you don't spend in a given year rolls over from year to year and continues to grow. There are no use it or lose it rules with your HSA. So who is eligible to contribute to an HSA? You can contribute to your HSA if you are enrolled in the high deductible health plan. You also cannot be enrolled in Medicare or 6 months prior if you're a late enrollee to Medicare. You can't be enrolled in Medicaid, TRICARE, or certain VA services in the past 3 months. You cannot be another person's dependent. You cannot be enrolled in any non-high deductible health plan coverage, such as a spouse's health plan or a regular health flexible spending account. You can only contribute to one pre-tax account, the health flexible spending account or health savings account, unless that is a limited purpose flexible spending account or dependent care flexible spending account. Who can you use your HSA dollars for? You can obviously use your HSA dollars for your own expenses. You can also use them for your spouse's expenses, even if your spouse is enrolled in their own employer's health plan. You cannot use them for a domestic partner unless that domestic partner is also a tax dependent. And when it comes to dependents, your children have to either be tax dependents under age 18, or if they're adult children, if they're no longer a tax dependent, you can no longer use your HSA dollars to pay for their expenses. If you have minor children of a divorce and you and your ex trade years on who can claim the kids on their taxes, this still counts as a tax dependent for the HSA purposes. So what is a pre-tax qualified medical expense for HSA purposes? Well, luckily, the IRS gives us a very clear definition. It's expenses primarily to treat or prevent a physical or mental defect or illness. So it's clear as mud, right? Well, luckily we have some great examples here in just a second, but I wanted to give you the actual IRS definition because I think it's very important for you to know that. If you use your HSA dollars for ineligible expenses, that is allowed, but you do pay income tax on those dollars and an additional 20% penalty. However, that penalty does go away after you turn 65. So what is an example of a qualified medical expense for your HSA? This would include things like your normal medical care, such as your deductible, copay, co-insurance, office visits, prescription drugs. Over-the-counter drugs no longer need a prescription as of 2020. Menstrual products were added in 2020 as well. In addition, medically necessary dental and vision care are eligible expenses as well. In addition to being able to use your HSA as a checking account to pay for your expenses throughout the course of the year, because these dollars roll over from year to year, you can also use it to pay for certain insurance premiums later in life. If you've ever had to pay for COBRA continuation, where you got the letter from your previous employer about how much it would be to keep your insurance at your old job, you know how expensive that is, but sometimes you need that between jobs, or if you're close to Medicare and need a little bit of coverage before that time. You can also pay for certain long-term care insurance if you can find it, as well as insurance premiums once you go on to Medicare, including the Medicare Part B premiums, Medicare Advantage premiums. The only thing you can't use it for is Medicare supplement policies after you turn age 65. Other expenses that are thought to be eligible but are not include insurance premiums other than what I already listed. So individual life insurance, for example, or your spouse's insurance premiums are not eligible. While you can't see me at the moment, I did ask about cosmetic surgery. They said no, but for non-cosmetic reasons, you can get medically necessary surgery done for breast reconstruction after mastectomy, for plate glass window, for a cleft lip, all those sorts of things. In addition, pet expenses also, unfortunately, are not eligible. So who keeps track of all this? Well, this is between you and the IRS. So throughout the course of the year, as you have expenses, you're going to keep those receipts either in an envelope or a folder. You're going to take a picture of them with your phone, and you're going to keep those for when you file your taxes. And at the end of the year, you're going to get a 1099 SA from the bank. That's going to say how much you spent out of your HSA. You're going to line those up to the receipts that you have, and if they're all pre-tax expenses, mark the box on your taxes and you're all set. If you have some ineligible expenses, you mark that as ineligible, and like I said previously, you pay the income tax on that, pay the penalty on that. As long as you mark it correctly, there's no harm, no foul. Typically, your employer establishes a default banking arrangement for you. In most cases, you're given a debit card to help pay for expenses. You can usually also transfer funds between accounts, use bill pay, order checks to pay for any payment plans you may have with the hospital, as well as access an ATM to perhaps pay yourself back. Some of the things to consider when you're deciding whether to enroll in a high deductible health plan with health savings account. Some of the pros include having lower premium costs, the ability to save money now and in the future pre-tax in that health savings account, the ability to use the funds in your HSA to pay for expenses as they come up, as well as having full control over your healthcare expenses. Some of the cons that come up are that all expenses must be paid up front towards your deductible, even if the funds aren't yet in your HSA. Hospitalization is a good example where perhaps you have a payment plan set up at the hospital, and so as money goes in your HSA, you can turn around and pay that bill with your HSA dollars. However, when you have prescription drug expenses, especially expensive prescription drug expenses, you have to be willing and able to pay for that prescription drug at the time you pick up the drug, even if you don't yet have money in your HSA. You can pay yourself back with those dollars later. This also applies to the timing of the expenses you have in the year. If something occurs early in the year and you don't have money in your HSA yet, you have to be able to build that up and then pay that as money goes into your account.
Thanks for your time today. I hope you found it educational. If you have any questions, feel free to contact us at rosestreetadvisors.com. Thank you.